welcoming you to the second day of the biggest investment event of the year, Masters of the Street Conclave. While we welcome our masters today, let me talk about what is the Masters of the Street. To democratize investments for all clients, we had launched Masters of the Street for all ICICIdirect investors in 2021. With Masters of the Street, we aim to offer ready-made equity baskets managed by leading investment experts, IIR Masters. Masters of the Street offers equity baskets across a wide range of themes, styles, market cap with an aim for long-term wealth creation for all our clients. For our clients, this offering is available on our web platform and the Markets app, where the end-to-end journey of investment, which is investing, tracking, rebalancing, is available in just a few clicks. Some of our masters who manage these baskets are Pankaj Pandey, the head of research for ICICIdirect, Mr. Sunil Singhania, founder of Abacus Asset Manager, Mr. Rajesh Kothari, founder of Alpha Accurate Advisors, Mr. Sundaram, ED and CIO of Equities at O3 Capital, Mr. Ashish Makankar, founder of Equipost Capital Management, and last but certainly not the least, our two guest panelists here, Mr. Pankaj Murakka, founder of Renaissance Investment Managers, and Mr. Shailendra Kumar, co-founder of Narnolia Investment Advisors. With the Masters of the Street Conclave, we aim to bring you all our cherished masters under one digital roof for a compelling discussion on markets. Today, our two topics will be, the first topic is emerging investment theme for the next 5 years. And the second topic will be, will 2023 be stock pickers market? Good afternoon, everyone. Welcome to today's episode of Masters of the Street. My name is Gaurav Avasti, and I head the UHNI segment and the family office for ICICI Private Wealth, ICICI Securities Private Wealth. Our two esteemed speakers don't really need too much of an introduction. Most of the market participants and clients already know them. But for those who don't, I'll give a quick introduction. Mr. Pankaj Murakka, the Chief Investment Officer and founder of Renaissance Investment Managers Private Limited. With over 20 years of experience in Indian equities, Pankaj is one of the leading investors and fund managers in India. He has also worked with some of the biggest companies and fund houses like Motilal Oswal, Rare Enterprises, Merrill Lynch, and Axis AMC, maintaining a high performance standard across the different funds that he manages. His investment philosophy is focused on investing in good quality companies that can provide significant and sustainable growth over the medium to long term. Pankaj believes in investing in good companies at reasonable prices to generate sustainable returns. When it comes to risk management, he has created a risk management framework that can help reach a sweet spot of risk to reward while investing in blue chip companies. This framework focuses on risk associated with the quality, price, volatility, and liquidity. Our other esteemed panelist, Mr. Shailendra Kumar, is the co-founder and chief investment officer of Narnolia Financial Advisors Limited. Under his leadership, Narnolia has won many accolades, including most consistent portfolio manager of the country in 2018 and 2019, while also being recognized as the second largest registered investment advisor of the country in 2021. Shailendra holds a postgraduate degree in management and systems from IIT Delhi. Apart from a successful investment manager, he has also authored several financial papers and publications. His investing framework takes into account the market conditions and its dynamics, the quality of management, the product besides the financial and valuation multiples. In order to manage risk efficiently, he ensures there is limit to the maximum weightage a particular stock and sector is given. Welcome, Pankaj and Shailendra. Thank you so much for being on the show with us today afternoon.
Thank you, Gaurav.
Thanks, Gaurav. It's a pleasure to be on this platform with you and reaching out to all the ICICIdirect investors. I really look forward to an engaging session with, you know.
So, today, I think this, we are also poised at a very interesting place in the market. And, we'll start. The topic of today's panel is emerging investment themes for the next 5 years. And if you look at what's really happened over the last decade, especially the last 6-7 years, majority of the global economy was near zero interest rates for the last 5-6 years. Large wealth creation largely happened in futuristic tech companies. With the current interest rate regime, globally going up, I want to start with you, Pankaj. And, do you think the theme, that really made money for the last few years, has that theme died today?
Very interesting and very profound question, Gaurav. Let me just highlight 2 or 3 points and I'll share my view. First of all, you're absolutely right. Last 10 years, the world has lived in an era where it was all about free money because central banks all over the world were printing money and we were in an era of QE. I think that world is behind us. The era of free money or cheap money is behind us, which effectively means when it comes to businesses and investing, the cost of capital has gone up or has gone up meaningfully, and investors and businessmen will have to learn to respect capital in that sense. Having said that, I don't think so that the technology or emerging tech has gone out of favor because let's understand one thing. Technology has made a profound impact on the world. It has made it has improved efficiency and productivity across industries, and world is immensely benefited out of that. So I don't think that that's going to change. And in fact, if anything, I feel more excited about the power of technology and what we can achieve as a society and as a world over the next 15 years, because we've just reached some inflection point in terms of evolution of AI with machines having intelligence now. What they can achieve over the next 10-15 years is going to be really extraordinary. Having said that, I think the way we approach these businesses as investors, where we inverted the whole pyramid or model of framework, where a traditional objective of a business is to make money from sell products to customers, charge them revenue, make profits and give it back to the shareholders. Last 10 years, because of cheap money, we've just inverted that whole model where companies were taking money from investors or shareholders and they were selling products to customers at discount and thereby making losses. So the whole pyramid just got inverted. I think that's not going to work anymore. Companies will have to be far more sensible in terms of building their business models. And one will have to be more careful in terms of how we value those businesses from an investor's perspective. But otherwise, I think I feel very excited about the future of technology and a lot of these emerging companies across different segments of technology and what they can really do to the society and the kind of opportunities that lie ahead for investors to invest within those companies.
Thanks, Pankaj. I'll ask the same question to you, Shailendra. What are your views? You think that decade of low interest rates and futuristic tech companies, that theme has died, where people made tons of money?
It has not surely died. I mean, as a user, you will be consuming more of technology, not less anymore, right? See, the idea, if you look at a larger construct, there are two phases happens in economy. And you can name them phase of innovation and the other being phase of productivity. You can go back last century, when the last century started, and you had innovation like electricity, tons of uses of electricity, and you had automobiles at that point in time, right? Initial phases, which I am calling phases of innovation, things are very, very disruptive, right? Wealth creation do happen at that point in time, but they are not like a consistent compounder. They happen as spur, just couple of years of large rally in those stocks, and then sideways movement for long term, right? Invariably, after some time, the phase of productivity enhancement comes, which I think now the current set of new age technology which has come will enter into it. Here, the financials of those companies will start looking more sober, the way we want to look at those numbers in a stock market, right? The capital efficiency will come into picture, cash flow will come into picture, right? Also, thankfully, for the last 1 year, for various reasons, the valuation multiple of those companies, which were like having, very different kind of a notion in terms of value, so different metrics they were using, now have come and realigned with normally the way we look at the stock market. So I think from here on, that basket is in fact more interesting from stock market perspective, because those companies will get some of the survivors which will remain there. They'll start talking in terms of capital efficiency. So they'll start becoming what the stock market likes more, what we call slow compounding, right? A consistent compounding growth in company cash flow. So these newest companies in some years after current phase of disruption which is going on, they'll enter into that kind of era to my mind. So in fact, that area is interesting for a stock picker from now on.
Thanks, Shailendra. So, the next question I will start with you, Sharinder. Last 1 year, we have obviously seen that the Indian markets have heavily outperformed globally. So do you think the next 5 years, belongs to maybe a country-specific theme like India, or emerging markets is back on the table, or value has performed over the last 2 years? Do you think value, that debate of value and growth, that is eternal, do you think value is coming back to the fore and will be the dominant theme over the next 4 or 5 years? So, I've just given some names. This is completely open to you. What do you think really works for the next 5 years? If you look at
a very relevant one. Yeah. So I would say emerging markets in general and India should be in particular. I'll give you one interesting statistical, the way you look at the previous last 40, 50 years of performance, there had been a very interesting statistical pattern, and that pattern alters every decade. So if you go back 1981-82 to 1991-92, the markets in emerging economy did phenomenally better than what the return from developed markets were. But then came 91 to 2001, where developed markets performed much better than emerging market in terms of stock performances. Again, it got altered, and between 2000 and 2010, you had emerging market doing phenomenally well. You can remember those Nifty rally, Sensex rally, right? Interestingly, in that sequence, the last decade, 2010-20, emerging market in dollar terms hardly did anything. It was all about US market performing phenomenally better, right? So if you look at those statistical construct, we are in an interesting phase, 2020-2030. And there are a hell lot of valid macro factors, which tells you very, very specifically that this is going to happen this time again, right? When it comes to India piece, there are tons of region, financialization, formalization, a lot of things are happening as a structural construct. I'll give you another global macro construct why I think India has a huge chance of performing well in this decade. We have entered into a rising interest rate era, right? All of us agree interest rates will remain elevated or will keep rising for some time. It will stay there for good many years, right? Interestingly, in the last 20 years, if you look 2000, 2020, the interest rate in India, if you look at 10-year bond yield, our 10-year bond yield traded on an average at a 4% premium to US 10-year bond yield. So we had a 4% positive spread over and above US, right? Now, when the world is moving up, are we also going to move by 4%? There is an interesting bit of twist here. Same time, China over the last 20 years, there the 10-year bond yield was just 1% spread over US 1%. And looking at various numbers, we can argue India is where China was, say, 15 years back in terms of macro construct. So my thesis for the next 10 years is our spread in terms of interest rate over and above US will compress continuously. So while on an aggregate basis, the world will remain elevated in terms of interest rate, in India, the same kind of interest rate transmission will not happen. The rally in interest rate or the growth in interest rate will not happen in that proportion. And that makes India a very, very interesting space for any global investor for the next decade. Right? So India in particular looks very, very exciting, apart from domestic factors you and I keep discussing, right? When it comes to style, growth or value, I think India has always been a growth quality market to my mind. If I go back, there will be some particular year like the one we had in the last year and a half, where the valuation has been more important a factor as far as the stock performance goes. But in a broader sense, in India, if you look at last 20, 30, 40 years, the quality company which are showing growth invariably does better. So I think that story will come back as we move in 2023.
Sure. Thanks, Shalinder. Pankaj, what are your views on, what do you think are the emerging investment themes for the next 5 years?
I think I'll talk from a global perspective, but let me first talk about India, Gaurav. I think the fact is what you mentioned in the beginning of the question, that this year India has done pretty well. And what I wanted to really highlight is that, India now is clearly an outlier economy in the world. You look through the world, the year gone by, we are at the fag end of the year. The world has had significant headwinds, given high inflation in the Western world, COVID-driven lockdowns in China, and conflicts in some other parts of the world, and so on and so forth. And India sort of emerged as a OSS kind of a thing, that despite global headwinds, India is still delivering about close to 7% growth this year. And more importantly, as we look forward to next year, we realize that the Western world, US and Europe, are at the brink of a recession. China is somewhat fuzzy because now that they want to reopen the economy, one is not sure in terms of how this whole thing will play out, given their low vaccination levels and stuff like that. And the fact is that in a world which is significantly challenged and struggling to grow, and probably where 60% of the global GDP will be into recession, India will still deliver 6% growth next year. The point I'm trying to make is two things. One, now India clearly is the fastest growing economy in the world amongst the major economies, because China's peak growth rate, in best case, if they deliver the best case growth, given their size and scale now, will not exceed 5%, and India's worst case growth is 6%. So the point I'm trying to make is, over the next 10 years, 15 years, India will be the fastest growing economy in the world, the major economy in the world. Yeah. And in context of that, I think my firm bet is that India will be the best. Indian markets, when it comes to equity markets globally, will be the best performing market over the next 10, 15 years. We've seen that, this happen country after country when a country reaches a particular inflection point, and from there, when the growth really accelerates, the kind of growth trajectory or the super cycle of growth that the country goes through, and what it translates in terms of wealth creation through stock market. And I'm saying that this has happened in Europe, when Europe went through industrialization. This happened in Japan for a period of 16 years, when Japan was going through its high growth and almost reached a point where it challenged America. It happened in US, where they had a secular bull market for 20 years in equities during the baby boomers from the early 80s all till the 2000. And yes, last 20 years was China's economic miracle, but it did not actually translate into wealth creation for shareholders, because all of us know that China, given the communist nature and the principles, there's no free markets there, and they don't follow strictly the rules of capitalism. But I think clearly India, so the point I was highlighting was that what we've seen, India being an outlier economy this year, is not just a one-off event, but it's a trend. And it's an economic miracle that India is going to experience over the next 15, 20 years. And this period of 15, 20 years, every country gets it. Once in every 100 years, every country goes through this super cycle of growth or economic miracle. And I think the next 15, 20 years globally are about India. So, generally there's a perception that investors fear that investing into equity is a risk asset class. And if you invest, equity is a risk. I've been saying this, that not investing into Indian equities is a much bigger risk than investing into Indian equities. But you just can't afford to miss that whole growth super cycle in a country when it to not invest into stock markets when any country is going through that growth super cycle, which India is at that point. So it's my firm belief that while interest rates are cyclical, inflation is cyclical, and all of these things change over a period of 2 to 3 years, India is a secular growth story over the next 10, 15 years. And I think it's the next economic miracle which is playing out. And I'm sure all of us know the various drivers of that, including our demographics, productivity, and so many other things. And I think one cannot afford not to invest into India. So my firm bet is that the best asset class over the next 10, 15 years is going to be Indian equities. And I firmly believe that investors all over the world will be, jumping hand over fist to put their money into Indian equities.
Thanks, Pankaj. So, Shailendra, I'll roll the next question again to you. The world has changed over the last 1 year. We have seen the US hiking rate substantially. We've seen close to 375 bips rate hikes in the US. So, from an investing framework, with this kind of global interest rate environment and still expected to increase, what has changed from an investing framework for investors? And how should they really invest in this new world of higher for longer interest rate regime?
Correct, Gaurav. We need to reconcile with the fact that now the world is in a rising or maybe a higher kind of interest rate regime. And many of us are sometimes still talking about the peak rate, etc., etc. For the last 40 years, we all have got accustomed of a falling interest rate environment. I mean, look at the US market, 1981-82, the 10-year bond yield was 13-14%, which went to 0% in 2020, right? And in the 40-year period, it was like the interest rate, if you look at in terms of how the movement happened, it was continuously lower bottom, lower top, typical sign of remaining falling for the last 40 years. So intuitively, all of us who has traded in the market has traded in that kind of environment in a global context, right? For regions, that era has completely over now. We are into a period of higher interest rate or elevated interest rate than in the past for a lot of macro regions, right? And we all have to adjust to this new reality. But we need to keep one thing in mind, we always feel higher interest rate will be bad for stock market. Prior to 1981-82, when US 10-year was say 12-13%, it had a huge rally in terms of yield for prior 40 years. So between 1941-42 till 1981-82, the rate kept rising and rising in this market. Almost from 2% 10-year bond yield went to 12-13-14%, right? And in that 40-year period, lots of bull market happened in US equity as well. So this notion of, adjusting too much because rate is going up, of course, you have to make your valuation multiple adjustment accordingly. That's very, very desired. But in terms of fearing from a broader stock market, because higher interest rate regime will be there for next decade, it will be difficult for us in equity is not a case in a historical perspective, right? How we can adjust, look at the right now in the last 1 year itself, when the rate were rising, banks were a clear winner, right? In their net interest margin, they have continuously seen the expansion. So it's a very, very simple way to, identify one area which has been directly beneficiary instead of having a problem with, right? Going forward, I think a couple of more sectors, similar sub-themes, like say insurance companies, because a rising rate environment, a little higher in interest rate environment is very good for an insurance company in terms of their growth rate of balance sheet size, right? So that again will be some kind of area. So there are plenty of rooms. Plus also in an overall basis, you should not worry because the rates will be higher. One thing will remain common as in the past also, and India has good many company of that variety, which we call quality company, right? They make sufficient cash flow every year that out of those cash flow, they can put some money for their capex internal, right? And they can sustain their growth for perpetually for many, many years. So those kind of a company, which are quality company, make sufficiently cash flow, and you can use those cash flow for their growth in the business in a foreseeable future in almost a linear manner. Those companies are the one which will have zero impact of these kind of rate change environment. Some adjustment on valuation multiple we all need to do. That's a different part of it.
Thanks, Shalvinder. Your views, Pankaj. How do you really navigate this higher for longer interest rate environment from an investor?
I think, yeah, sure, Gaurav. I take your point. The fact remains that, the era of free money or cheap money, as we've been used to for last probably 15 years after the aftermath of global financial crisis, where central banks all over the world have been embarking on extraordinary liquidity infusion and money printing or quantitative easing, as we've been calling it out, is behind us, given that now inflation has really caught up and surpassed central bank's expectation. And currently, as we speak, they are significantly above central bank's targets. So I think I think as we look forward, the fact is the cost of capital has gone higher. And for a foreseeable future over the next, let's say, next 5 to 10 years, I think the cost of capital will remain high. Given the context of elevated interest rates that we're talking about. We're not talking about an environment where, meaning 80s was slightly different because we really got into something called hyperinflation and stuff like that. I don't think so the world is anywhere closer to that, given that there are significant challenges that the world faces. Having said that, inflation can and probably will remain somewhat elevated over the next, let's say over the medium term, over the next 5 years. And in that context, I think given higher interest rates, cost of capital has gone higher, which effectively also means that last 10 years, I would like to say that a lot of growth businesses were sort of mispriced. When we have seen a lot of companies which were delivering like, let's say in the Indian context, about 10-15% growth, and they were trading at 70-80 P or something like that. And when you do a valuation check on them in terms of reverse DCF and all of that, there's no way you figure out that as an investor, you can make money in those kind of companies. So I think There'll be valuation sanity and valuation in the markets where the cost of capital will have to be respected. Every business and every entrepreneur will have to make tweaks to their business model to generate adequate return on capital, which was not the case in many cases, and especially a lot of these loss-making businesses. And more importantly, I think for those mispriced growth businesses, valuation will get moderated. More importantly, the other point I think which will make a difference is given the fact that inflation will remain somewhat elevated over the next 5 years, and given the fact that real interest rates in the world are negative because fixed income, let's accept the fact that fixed income markets across the world are completely distorted because central banks are manipulating fixed income markets across the world because they being bankers to the government and the governments being the biggest borrower all over the world. Fixed income markets are not giving inflation hedge to investors, which effectively means, to my mind, the only inflation hedge investors have in an inflation environment is equities, because at the end of the day, equity is a growth asset and growth can compensate for that inflation. And within equities, I think investors should have some allocation to what I call businesses which are income generating businesses or which are inflation hedge. And these are typical businesses with very strong pricing power. And as a result of which they have the ability to pass on the increase in their raw material cost or the cost of doing business to the customers without having any meaningful impact on their business. So take a classical example of telecom companies, let's say a Bharti Tele or a Jio in India's context. These companies can easily pass on rate hikes or price hikes to the customers. And I don't think so customers for a moderate price hike will start reducing their telecom consumption. Or take a classical case of utilities, which are providing us services like power and transportation, where these companies can comfortably pass their price hikes to the customers and without having any meaningful impact on the demand. So I think investors will have to have some exposure to these businesses which have very strong pricing power, because these and also most of these businesses generate very strong amount of or very high amount of free cash flows. Now, so they are sort of a cash machines in an idle context. So I think given the fact that, as I said, fixed income yields are negative or fixed income markets are manipulated, the only hedge investors have against inflation is equities because of the underlying growth in the equities. Within that, investors should have some part of their portfolio into businesses which are income generating or inflation hedge equities, I would call. And I think that's very important for investors to have in their portfolio.
Thanks, Pankaj. The next question, I start with you. So over the next 5 years, specific to India, what sectors, what themes, or maybe, pocket of ideas do you think will really work out? How did this play if you have to look at it specifically to India?
Sure. Good question, Gaurav. So Gaurav, there are a couple of themes or sectors in that sense which I feel very excited about when I look around at how India is going to evolve over the next 5 years. Let's say currently where we stand, we are about a $3.2 trillion economy, and over the next 5 years we should surpass $5 trillion. And how does it play out, and how does it trickle down in terms of sectors? So one clear visible trend is we are seeing is a very strong revival in India's investment cycle, which has been completely missing over the last 10 years. We're seeing early signs of investments across some of the core sectors of the economy, including power, including utilities, including the core industries, which includes commodity sectors like cement, steel, and so on and so forth. And we are seeing a lot of large projects which are at an early stage of hitting the ground or at the drawing board stage, and which will hit the ground over the next 12-18 months, and which effectively means India's investment cycle will revive, and as a result, India's capital goods and engineering sector should do very well over the next 5 years or 7 years. In fact, this year gone by, capital goods as a sector, I think is the best performing sector. If you look around in terms of the breakdown of various sectors, and probably been one of the best performing sector this year. So I feel very excited about capital goods and engineering as a sector. Another sector, financials obviously will do well, because financials, when it comes to finance, if the economy is doing well and delivering strong growth, then finance is at the heart of the economy. And if the economy does well, then finance has a very strong role to play across the entire ecosystem, be it credit disbursement, be it managing savings or other parts of the ecosystem. So finance will obviously do well. But another sector which I feel really excited about is the whole technology sector. You just, to give you a very high level overview, look the entire India's tech ecosystem or the technology economy, and it's about $100 billion in size, which is about 3% of India's GDP. My view is, given the increased or accelerated digital adoption that we are witnessing across governments, across businesses, and across consumers, as consumers also we are digitally adapting ourselves, and the consumption of technology is only increasing. So a lot of things, let's say, for example, that we were doing physically pre-COVID, now we've started doing digitally, like we're doing this conference digitally now. Or let's say something simple as that I used to read physical newspapers pre-COVID. Now I've got used to reading my newspapers digitally on my handheld device. So I think my view is that India's digital economy, which is about $100 billion when you take everything across sectors, this will grow at like north of 20% over the next 10 years, and it will become $700 to $800 billion, and about 14-15% of India's overall GDP over the next 8 to 10 years. So I feel very excited about technology as a sector. After a very long time, I'm seeing a sector which can deliver very high growth on a sustained basis for a long period of time. Meaning something like this I'm seeing after a gap of 20 years. The last time I saw this was in the mid 90s to late 90s when IT sector was growing at that pace. So I feel very excited about technology. We've seen a lot of these tech companies got IPO'd, but and many more will get IPO'd over the course of next few years. I understand that some of these companies have not done well last year, but I think that's primarily because these IPOs are mispriced. But I think for the some of these companies are looking very exciting, and I'm sure we'll see many more companies getting listed. So I feel very excited about technology as a sector over the next 5 to 7 years.
Thanks, Pankaj. Shalinder, your views in terms of sectors, themes, other pockets of opportunity in India, specifically over the next 5 years?
Yeah, Gaurav. See, Indian market always has given, lots of different sectors to play with, tons of themes to play with. I mean, along with US and a couple of more countries globally, India has that much of a diversity in terms of opportunity you have as a stock traded, right? And I think right now we are at that kind of a point because we are thinking about a decade kind of a rally for India. In that context, you have opportunity in every segment of the economy, every theme you can bet on. Maybe something will not work for a year, but ultimately will turn up again, right? Look at the financials. Last 1 year, they have already done pretty decent. And I think from the base where they are starting. So in the last 4 or 5 years, 6 years, whenever the banks were going up, only few retail franchises were going up, right? It was not a general banking kind of a rally happening. Interestingly, banking sector has come out after a lot of pain, right? So in 2014, you had an aggregate advances from Indian banks to the tune of 40 lakh crore. And nearly 1/3 of that became NPA between 2014 and 2018, right? Because of a lot of things done. Today, they have never been such a clean balance sheet of Indian banks. Since I am looking at the banking sector, I go back 30, 40 years when I started looking at the banks initially. Indian bank balance sheet were never so good, right? And in terms of aggregate credit in the economy, we have a lot of headroom to grow. So that's a very good space. It has already performed. It will keep performing to my mind. In every pocket, look at the investment aspect of the economy, industrial sector per se. Of course, because of the run-up of the last 1 year, valuations are a bit challenging. So to be very, very selective in that manner. Go to the consumption. Even in the consumption side of the part of the basket, look at a lot of retail company in India. Where the formalization is giving them huge amount of advantages in terms of the growth opportunity, right? So they also will be good. So my idea is, any theme you can bet on India right now, things are in the whole engine is, it is such a strong shape that every theme out of India will start growing, in maybe one time span or the another kind of a time span. But you can be very, very generic betting on India as an aggregate per se, right?
Thanks, Shalinder. Both of you have been extremely positive outlooks on India. Glad to hear that. Now, I really shift to one of our neighbors, China. And, we have been talking about the China plus one theme for a long time. Given what is happening in China, post-COVID supply chain, now real estate crisis, do you think that theme will accelerate meaningfully for India, or will countries like Vietnam really take a larger pie? Shalinder, maybe if you can start first.
Sure. Surely, I mean, China is a big angle, right? So whenever we think about financial market, we all look at US, right? So what happens in US gradually happens across the world. China, for some, I mean, all the region known to all of us, has got a kind of a cloud where when China does something, the manufacturing, gets some kind of a impact all across the world. And we are having those, we are seeing this COVID kind of a lockdown that you spoke right now. Surely it's a big issue and naturally an opportunity for a country like India, right? But there are two things we need to remember in this opportunity. China is not locked down forever, right? China will open, maybe a couple of months, maybe a couple of quarters, it will open. So we will have to readjust all our thinking in terms of how to play this China plus one kind of opportunity. That has to be, we need to be very, very cautious on that particular theme. Number two, the safer thing to play in that kind of aspect is look at it specifically. We were also importing a lot of things from China. So the opportunity where the import substitution is concerned, vis-a-vis China import, to be very, very specific, that one area, that one niche is appears much more, stabler to my mind in terms of the kind of growth they can exhibit. Secondly, in some of the industry, we already have a international level quality recognition and we are cost competitive, right? So even if China plus one, to what extent it plays out, how gradually or how fast it happens, still they have a edge in the business. So these two specifically, import substitution vis-a-vis China import that India had in the past, and also a couple of areas, maybe say auto component, maybe a couple of chemical things, where our quality standard is, across the world recognized, and we already have a cost advantage over China. So I think the safer way to play will be that.
Actually, your views, Pankaj?
I have a slightly different view, Gaurav. I think this time around, this China plus one is for real. And I'm saying this basis my conversation with a lot of companies in India and also my reading of a lot of global companies in terms of what they're saying and what my analyst team does in terms of tracking those companies and listening to conference calls. One common agenda, which is there on the CEO's to-do list of the Fortune 2000 or the top 2000 companies of the world. One agenda which is common on all the CEO of top 2000 companies to-do list is to debase or de-risk their manufacturing from China. The fact is China is central to the world and entire world's manufacturing is concentrated in China. And that's the Chinese miracle, part of the Chinese economic miracle that happened over the last 20 years. But the fact is, COVID has made the world conscious of geopolitical risks and external events. The trade war between US and China is not something which is there for the next couple of years. It's something which is going to continue for the next 10 years, 15 years, because it's all about eventually who appears to be a more dominating force, economic force in the world. And there's a clear message, subtle message to all the large US companies from US government to de-risk their manufacturing from China or reduce their dependence on China. One cannot completely move away from China because China is really large. But I think this time the globally companies want to move away from China. Point number one. Point number two, I think India has played its card very well this time around with our whole PLI linked incentive scheme, where we're giving incentives for setting up new manufacturing in India. On top of that, India now has the lowest wage cost in the world. China is not cheap anymore in terms of labor cost. In fact, China's labor cost is almost at par with Europe. So China is not cheap as a manufacturing base anymore. It's expensive. Yeah. And India is significantly cheaper than China. And finally, with the tax incentive, where if you set up a new manufacturing in India, direct taxes in India is only 15%. So it really makes anyone, for a global company, India becomes a very powerful and a very compelling proposition to set up the manufacturing base. The point you raised about, you made a very interesting point about Vietnam. You're absolutely right, Gaurav, that when it comes, we have actually, as Indians, we have not done a good job in reviving our manufacturing or exporting ourselves to the world in the last 15 years. And it's unfortunate that, all of these countries which are very small, which are a small fraction of India, when it comes to auto ancillary exports, Thailand's auto ancillary exports are higher than India. When it comes to textiles, Bangladesh has overtaken India. When it comes to electronics, Vietnam is higher than India. And it's very ironical because all of these countries are very small in relation to India. And yet they've done much better job than India. But I think finally India's got it to act together. And I think with the kind of ecosystem we have in place, I think this China plus one is for real. And I firmly believe that if you look at the world, India's contribution, India's market share in global exports is just about 2%. I think over the next 15 years, it goes to double digits, 10%, which is a very huge leap from where we are in terms of what we are talking about. And I think there are huge opportunities that will emerge or are emerging. I can just give one anecdotal example, if you allow me. If you take the case of the largest consumer product in the world, single largest consumer product in the world, that's iPhone. Now, today, 94% of iPhones are manufactured in China. Until few years back, India's market share was 0. Currently, we are at 3%. India will go from 3 to 45% in the next 6 years. So effectively, Apple really wants the largest consumer product, 45% of that will be manufactured in India over the next 5 years. Now, that's a very significant shift, very significant shift. And I think something like this will happen across industries and across product categories. So I think that this is a very exciting story, and it's going to play, in fact, I think it's going to be playing a very important role in terms of accelerating India's growth over the next 10 years.
Thanks, Pankaj. So maybe I will, now come specific to your strategy. You are advising Alpha Blue Chip and Alpha Dynamic Thematic Portfolio on ICICI Securities on the Masters of Street platform. Both of these have done well. They have delivered 13% and 10% respectively since launch. We've spoken of so many things. So in context of your portfolio in Masters of the Street, can you really share some more light in terms of how do you manage the portfolios, and given your bullishness on the Indian ecosystem, what really should be the investors' return expectations over the next 5 to 10 years? And what do you think are the key risks really, on the investment style that you run?
Sure. So let me just begin with giving a very high-level overview on the portfolio. The idea with Alpha Blue Chip portfolio is very simple. My firm belief is that any investor wanting to get a meaningful returns out of equity just need to own 20-25 stocks in their portfolio. Investors should not own anything more than that, because anything more than that will be counterproductive and will have a negative impact on their portfolio. The idea with Alpha Blue Chip portfolio is, let's say, out of the 2,000 odd stocks which are listed on NSE, how does the investor go about selecting those 20 or 25 best companies at that particular point of time? Yeah. And which is what exactly Alpha Blue Chip is. So my simple idea is, and we call these companies which form part of the Alpha Blue Chip portfolio as diamonds of the stock market. Because essentially what we're trying to do is, out of the 2,000 odd companies out there, we're just selecting or creating a portfolio of 20-25 companies across multiple sectors, a diversified portfolio. So bear in mind that effectively means that to create that 25 companies portfolio, we're eliminating 99% of the listed companies. We're just selecting 1% of the listed companies, which effectively means the bar for those companies to get into the portfolio is relatively very high. In every sector, you have 15, 20 at least good companies, even if you eliminate poor quality companies. Let's say when you talk about consumer as a sector, you have a Lever, you have a Dabur, you have a Britannia, you have a Procter & Gamble, you have a Asian Paints. But within the Alpha Blue Chip portfolio, only 2 or 3 companies from the consumer can come into it, because it's a portfolio which is spread across 10 sectors, which effectively means all of these companies are, and all of these, I think, to my mind, these are the best companies, and they're not only the best companies in India, but even by global standards, they're very well managed, excellent companies. And these companies are competing among themselves to get into the portfolio. So then finally, what the portfolio get is really diamonds of the stock market, is what I call, what we call with Alpha Blue Chip. So the idea with Alpha Blue Chip is very simple. Any investor wanting to invest into stock markets in the high quality, high growth companies and just sit on them over a long period of time should just buy Alpha Blue Chip portfolio for a consistent return over a long period of time. And I call it a low risk portfolio because these are companies which are very high quality in that sense. And at appropriate time, whenever any company, let's say, reaches a target price or where the return potentials are not significant, the portfolio manager will make adequate changes to the portfolio. So that's Alpha Blue Chip. The other portfolio we run is Alpha Dynamic Thematic. The idea with that is very simple. Every 2 to 3 years, we get a theme in the stock market which works very well. And if you invest into that theme, then the returns can be really supernormal. But every 2 to 3 years, that theme keeps changing. So some point of time, let's say IT was a theme way back, there was infra as a theme. So when we invest in thematic portfolios, the theme has to stay relevant and one has to keep changing the theme. So the idea with dynamic thematic is that we will keep changing the theme of the portfolio every 2 to 3 years to make sure that the theme remains relevant with and in sync with the underlying economic trends and underlying market trends. The current theme we are running in Alpha Dynamic Thematic is very simple, is growth and income. Income, essentially, I talked about earlier, is an inflation hedge. I think any investor wanting to invest into equities at this point of time need to have a good part of his portfolio, which is inflation hedge equity, which are essentially businesses with very strong pricing power and very strong cash flows and dividend yields. So there's a part of the portfolio, 1/3 of the portfolio, which we run as inflation hedge or income earning equities. And having said that, India is a high growth economy, which will still keep growing at 7% CAGR over the next 5 years, my view, despite headwinds in the world. So the balance, 2/3 of the portfolio is the growth part of the portfolio. So under the thematic portfolio, bringing both of this together, and the current theme we're running is what we call growth and income, which gives him the best of both the worlds. You get growth on one hand and you get inflation hedge on the other hand. So that's primarily a high-level brief on both the portfolios we've run. Yeah, both the portfolios have done pretty well over the last 2 years, 2.5 years that we've been running the portfolio. I feel from a returns perspective, I have this simple idea that last 20 years, if you look at index itself, in Nifty 50 index, it's done a 14% CAGR over the last 20 years. My view is next 20 years, India's growth will be better than the last 20 years. And in that context, I think the index will do much better returns than what it has done over the last 20 years. And in that context, an active manager like ourselves, who's trying to invest into high quality companies and find valuation, pockets of valuation disparity in the market where we can buy good growth at better valuation, we obviously intend to generate meaningful alpha over the index. Last 2 years, 2.5 years with the advisory portfolios, we've been able to generate alpha, which is about anywhere between 8 to 10% over the index. So we obviously intend to deliver a much healthier alpha over the index. So I think, having said that, as they say that we should keep our expectations moderate so that we only get positive surprises in life. So I would say is that high teens or 15 to 20% kind of a return from Indian equities and from our portfolios over a medium to longer term is a very reasonable expectation.
Thanks, Pankaj. So, Shailen, really coming to the specific portfolios that you manage on Masters of the Street, you are advising market cap specific portfolios, NS industry leaders, NS multi-cap, NS mid and small cap, and a very interesting thematic strategy, which is NS 5T to 5T on the ICICI Securities Masters of the Street platform. Specifically talking on this thematic offering, it's really delivered 14% over the last 6 months. And in light of our discussion here, can you really give us some light in terms of how you managing this portfolio? And typically, again, what are the return expectations for investors over the next 5 to 10 years? And what will be the key risks that you really envisage in the investing side?
Yeah, Gaurav. So basically, our investment thesis that we have is very similar, common to all the 4 portfolios we manage. I'll come to this 5T in a bit. We make sure that we identify only quality company. And when we say quality, it means both in terms of quantitative attribute like free cash flow, capital efficiency, as well as the management qualitative aspects of running the business, right? So identifying only quality company. And when those quality company are going to exhibit good amount of growth in the next 3-4 years, we enter into those stocks as a buy, right? Our other metrics that we are very, very clear about is that is in terms of predictability. Whenever we are picking a stock, we make sure that we have a very high degree of reasonable understanding how the financials will look like 3 years down the line. We don't want to buy any stock just because there is a possibility of that company becoming large. We need to be having very, very clear, demonstrated number-wise understanding of where the company will stand in the next 2-3 years. So these 2 attributes, buying quality when they are exhibiting growth, and secondly, being very, very cautious in terms of buying only those companies where we have a circle of competence in terms of predicting that company, where the finances of the company will be in the next 2-3 years, right? That thesis remains similar across NS industry channel, multi-cap, mid to small cap, and 5T. 5T is primarily a thematic investing. My own understanding in the past is like thematic investings are kind of a high risk, high reward kind of portfolio as a basket, right? So what we have done in 5T is instead of buying one theme, we have mixed 5 themes together, form one single portfolio, right? The number of stock in the portfolio NS 5T always remains close to 20. It's not like we buy a lot of company to represent that 5 themes. So we try capturing 5 different themes by buying only 20 stocks in a portfolio where we have a very high degree of certainty in terms of what the companies of the portfolio will deliver in the next 3-4 years in purely finance. right? And themes will keep changing whenever we feel like there is a higher predictable theme that comes to our radar, right? So we have the financialization theme, we got a digital theme in a portfolio, formalization theme, healthcare spending theme, economic revival. Right now, those 5 themes are there, where we have a very high degree of certainty in terms of the company we have in the portfolio, what number they're going to deliver in the next 3 years, right? So that's a very, very stricter kind of a approach. It's not like on a top-down basis, you pick a theme, put money on some 2-3 year stock of the theme, and then you hope for a good kind of a return in the market. We are very, very thorough in our approach of picking what stock has to enter in the portfolio. Going forward, the way I look at the kind of company we have in the portfolio right now, the kind of earning trajectory we see for those companies going forward 2-3 years, and the valuation headroom that is available for those companies in a, say, terminal 3-year kind of forward, we believe something closer to 20% would be the CAGR one can expect from the 5T portfolio.
Thanks, Shailendra. So we are running out of time. So maybe I'll just pick up a couple of questions from some of the questions that the audience have asked. And both of you, whoever wants to take it up, you can take up. So I'm sure this is a question which is close to the hearts of a lot of people. What is your outlook on the trending topic of Bitcoins and cryptocurrencies, and any opportunities in equity markets with the increasing prevalence of blockchain technology? So Pankaj, Shailendra, any of you want to really take it up? And
the piece, the blockchain technology part, I think I keep you all speaking, like a lot of financial companies are trying to use blockchain technology one way or the other, right? All these new age things which has come as a technology part of it, those technology adoption will keep happening in the future also. It's like .com burst, right? After the .com, we did not stop using the internet. In fact, only we increased the use of internet, right? But the company which was there behind those, so a lot of those vanished, right? Same thing is going to happen this time also. Particularly in crypto, I don't have a very positive view upon as a currency. Maybe I don't have an understanding on cryptocurrency per se, but I don't have a very positive view on cryptocurrency as a future. But blockchain technology, for sure, I think there are a lot of takers in many field. The depository, the insurance company, a lot of banks are talking about in those sense.
Thanks. So the other question. So there are a couple of questions. One is around CPI inflation, and the second is around the Fed meeting and has it changed the expectation. So I'll just, I think some of it we have covered, but I'll just try to summarize these 2-3 points and say that given the current inflation environment and the Fed's aggression, do you think we have to be really worried and careful over the next 6 months, 1 year, or do you think that most of the impact is already there in the markets and we don't have to worry too much?
Well, maybe I'll take that.
Sure, Pankaj, go ahead.
Sure, thank you. So I think the fact remains that we are near peak inflation globally, and probably we are closer to peak interest rates. We are not there as yet because probably next week we have a Fed coming up and probably we'll see another 50 basis points rate hike, which is what the consensus is all about. But having said that, I also believe that over the last course of this year, the Fed has covered significant ground because they were significantly behind last year. Start of this year, Fed rates were at 0. Now probably we'll end the year with a rate hike coming next week to 4.5%. So I don't think so. There's much more to go from the Fed side. Probably another couple of rate hikes in the early part of the next year, and probably as the consensus is, the Fed will go into a pause sometime towards March, April of next year. Well, it's always difficult to time markets from a short-term perspective. I think the meaning is difficult to time. It could lead to some correction, probably 5-10%, but I don't see a big catastrophe or a big global sell-off happening. And maybe I can use 60 seconds to highlight this. While the, let's say, US economy is in all probability, and my view as well, will get into a recession next year, we need to distinguish between, not all recessions are same. We need to distinguish between a recession in a deflationary environment or a deflationary economy, which is what the case was last 15 years, and a recession in an inflationary economy. and the world has not seen a recession in inflationary economy in the last 40 years. So we don't have we don't have a right precedence to compare it with, but I can share some insight. So generally what happens in a recessionary environment is we have earnings contraction. But in an inflationary environment, when you get a recession, we can still have nominal earnings growth because price gains are significantly higher. And which is what at least my base case is for US going into next year. And which is why I think I don't see a significant downside to US markets despite risk of US economy slipping into recession next year, because I still think that they can have nominal earnings growth. So it's difficult to time short-term corrections. But beyond that, I don't see a catastrophe or something or a big sell-off in equities globally.
And thank you so much. Thanks, Pankaj. Thanks, Shalin. Thank you so much for being a part of the panel. It was really, really interesting and enlightening hearing both of you.
Thank you, Gaurav. Thanks a lot.
Thank you, Gaurav. Thanks a lot. It was wonderful talking to you, and would like to thank all the people who've taken their time out to join us on a Saturday evening. So it's wonderful and some very insightful discussions. So thanks a lot.
Thanks, and thank you everybody for joining in, and please stay tuned in. Our next panel is going to be equally interesting. And the topic of the panel is, will 2023 be a stock pickers market? So we will take a quick break of 5 minutes before we start the next panel. Good afternoon, and welcome everyone to the second panel of today's Masters of the Street Conclave. And the topic of the panel is very interesting. Is 2023 going to be a stock pickers market? And we have our two esteemed and extremely insightful guests who are there to really help us take this discussion forward. So, Mr. Rajesh Kothari, he's the founder and managing director of the driving force of AlphaAccurate Advisors. He and his team believe in the motto, protect capital, create wealth. This investment philosophy is focused on long-term wealth creation that is resilient even during market fluctuations. Prior to founding AlphaAccurate Advisors, he was a fund manager at DSP Merrill Lynch Fund Managers. And during his tenure, the fund's assets flourished from USD 100 million to a staggering USD 1.5 billion. He's an MBA and a CWA degree holder and believes in making high conviction investments in companies with strong moats and high growth potential that offers solid long-term risk-adjusted returns. During the last 12 plus years, his flagship PMS AlphaAccurate Advisors India Opportunity Fund has delivered a 18.6% CAGR versus BSE 500 index CAGR of 12.4%. Welcome, Rajesh, to the panel. Hello. Our second panelist is Mr. Pankaj Pandey, the head of research of ICICI Securities Limited. Pankaj has more than 2 decades of experience in the Indian equity markets, out of which he has spent 18 years in ICICI Securities in various capacities. In his current role, he heads the research desk and helps with his nuanced views on the overall market. Prior to joining ICICI, he worked as an analyst with Asian Kirk covering various sectors. Pankaj is a PGDBA and a CFA degree holder, and his investing philosophy is to prefer capital efficient businesses with robust growth prospects. While curating different baskets, he also places emphasis on managing risk by applying limits at sector and stock level. So welcome Pankaj and Rajesh. Thank you so much for joining us in this panel today.
Thanks, Gaurav.
Thank you. Thank you very much.
So Rajesh, I'll start with you. We've had this almost a Goldilocks scenario over the last 2 years, post-COVID, where we saw everything going up thanks to the abundance of liquidity entering capital markets. Now the monetary policy across the world is changing, and we have talked a lot of times about the TINA factor that debt returns were very low, gold was not working. So in this current environment where interest rates are high, how is the investing framework changed? How are you really looking at it? I was just reading an article today that gold over the last 5 years has outperformed the US markets on dollar terms.
Sure. So, so first of all, thank you, Gaurav, and really thanks to you for providing us a wonderful opportunity. And I think it's a really great platform to interact with investors. And I think this platform itself is playing a transformation and revolutionary role for further financial inclusion, particularly for retail investors. So thanks once again for that. I think, you have a very right question, and I'm sure many of the investors also would have similar thoughts in their minds. So what has happened is that in 2020, whatever you touch becomes a gold. आपने जो भी लिया 50% बढ़ गया, 100% बढ़ गया, correct? And then 2021, from October 21 now till December 2022, it became completely different environment. From Dow all-time high in 2021, half of it, and then significant correction in the world market. Not only in equity, even in the global bond asset class, if you look at it, there is a significant decline even in the bond as an asset class. But in such environment, what has worked is only one thing: the good fundamental, high quality companies. And if you buy that as a reasonable valuation, one can always debate equity, debt, real estate, gold, but one knows the answer that over last 10 years, over last 20 years, over last 30 years, the equity market has always delivered super returns compared to any other asset class, be it in the global market or be it in the Indian market. More importantly, for Indian investors, we should not worry too much about what is happening globally and all about different asset classes. We should worry about only one thing. How can I make my money? Period. बहुत सारी चीज होती रहेगी, बहुत सारा डिबेट, कंफ्यूजन, रिसेशन, एक्सपांशन, इन्फ्लेशन, डिफ्लेशन, हाई इंटरेस्ट रेट, लो इंटरेस्ट रेट, क्रूड ऑयल गोइंग अप, गोइंग डाउन, बहुत सारी चीज होएगी. Every day, lot of WhatsApp will come. But only those who believe and keep faith in equity, they'll make huge long-term returns. Because remember one thing, for world there is a debate. 1% growth होएगा कि -1% growth होएगा. For India, the debate is 6% growth होएगा कि 7% growth आएगा. So India is in a very, very sweet position. Believe me, it's a time for India. मेरा टाइम आएगा. मैंने कल भी बताया था इन्वेस्टर को, अपना टाइम ऑलरेडी आ गया है. So just keep faith and believe in equity and stay invested in equity.
Thanks, Rajesh. Pankaj, your views, we have heard so much about the TINA factor over the last few years. So, has the TINA factor changed now for equity, given the fact that debt returns are attractive? Some of the real asset classes also seem to be working right now.
Correct. So when you sort of look at the historical construct, Gaurav, I think what has happened is that when COVID wave hit, almost all the central banks were in easy policy mode. And that sort of lifted almost all the asset classes, especially equities. But now you are in a sort of a monetary tightening mode, and which is why the debt is sort of finding favor. But our sense is that, so while this kind of a monetary tightening can be there for some period of time, but our sense is that given the way debt to GDP ratios are very high for a lot of economies, a higher interest rate regime over a longer period of time will not work. And which is why our sense is that debt structurally might not be giving that kind of a returns what it would have sort of given historically. Now, when you sort of come to equities, like what we have seen, see, India is going to grow at 6 to 7% and overall, I think one of the competing geographies, if you look at, say, China, there the growth rate sort of tapering down. Yes, from a valuation perspective, we are sort of rich, but I think when somebody is looking for a stable growth economy, I think the TINA factor within equities is going to sort of work. So from that perspective, I think overall India as a equity asset class is going to remain in limelight. I don't expect Indian equities to sort of keep outperforming all the periods of time, but structurally, if somebody is looking for next, say, decade, I think India is a market where one can see 6 to 7% kind of a sustainable growth rate with no major red flags from a policy-wise perspective. I think we have one of the best macroeconomic stabilities. So I think next 5 to 10 years belong to Indian equities. So TINA factor, not equity-wise, but within global equities, I think India is definitely a TINA factor to sort of look at.
Thanks, Pankaj. So next question, I'll start with you. So 2022 has been a very interesting year, and there are two ways in which you look at it. One is that the Indian markets have heavily outperformed the global markets, and the second is that on an absolute basis, we have not really done something fantastic after whatever we had done over the last 2 years. So as we come to this end of the year, how are you really looking at the next year? Will the global outperformance sustain? Do you think we'll get far more superior absolute returns for the coming year?
So Gaurav, like you highlighted, yes, we are the best performing market this year. So our markets have already sort of touched new post-COVID highs. Whereas when you sort of look at a lot of other developed or emerging markets, or something like Hong Kong is down 40%, a lot of other markets are down mid to high teens. So from that perspective, I think Indian markets have clearly sort of outperformed. And when you sort of look at valuation wise, we are definitely sort of rich in valuation. Now, our sense is that going forward, when you sort of look for next 2 years, I think corporate earnings are looking very good. So you have 50% kind of a overall CAGR growth in earnings is very much around the corner, given the fact that some of your bigger sectors like banking do not see any kind of a major issues in terms of the gross NPAs or credit cost impacting earnings. And then I think government is making all the right noises on the capex front. For next 2 years, we would expect corporate earnings to be a lot more stable at about 14-15% kind of a CAGR. I think whatever margin volatility we have seen, I think hopefully we will not see. But having said that, since we are sort of rich in valuation, so we would expect market returns to be around those levels only. So even if there is a bit of a re-rating, which we find a limited cost, overall market returns also could be mid to high teens. Now, when you sort of look at a lot of other global markets, they've been beaten down like anything. So obviously, it is possible that the other markets can outperform Indian markets. But our sense is that despite that, India is going to give an absolute return of mid to high teens. And that is what we have been sort of projecting in terms of our target prices for Nifty next year. And since overall Indian economy is sort of shaping up well, so our sense is that you'll see mid caps and small caps are doing even more better compared to large caps. In fact, when you sort of look at small cap is still down 15-16% from their previous size, unlike Nifty, which is already sort of touched a new high.
Thanks, Pankaj. So Rajesh, I heard your last answer that you should forget everything and just focus on India and the company. But I'll still pose this question on you that how do you think 2023 pans out for the Indian markets, given what has happened in 2022, given relative outperformance and maybe lower absolute returns for the Indian market?
Basically, 2022 was a year of challenges. There was a Russia-Ukraine war, which nobody would have thought in December 2021, just 1 year back, rewind. And if would have told you somebody that in December or March month, there'll be Russia-Ukraine war, you would have sold everything. And you would have said, you know, I want to be out of any asset class, be it equity or debt, correct? But look today, Russia-Ukraine war already happened. Crude went to 130. Supply chain index pressure went up like anything. All commodity prices zoomed. And despite everything, Indian economy did extremely well. Despite everything, Indian equity market reasonably remained stable. So I would say 2022 was a year of consolidation. From here, think as an investor. What are the worst? What can be the worst from here? The worst of peak of inflation is behind you. Peak of interest rates in India is behind you. Peak of supply chain pressure index is behind you. Peak of the worst headlines on front page of Times of India is behind you. The worst of the credit cycle is behind you. The worst of the borrowing conservativeness is behind you. So many big negatives, the baggages, now they are behind us. From now, what is going to happen? The right to win. We have a now right to win as an economy. We have a right to win as an emerging country for FIs to invest in market because China has done so many blunders. Today, the globally companies are looking at India, whether you look at China +1, whether you look at Europe +1. So India has a fundamentally right to win. Now, Gaurav, what happens in this right to win kind of an environment? Naturally, because of the unique positioning of the economy and the country, it will attract huge liquidity, FDI, PE, VC, FII, domestic retail. Everybody will look forward to India over next 2 to 3 to 4 years. So we are a very, very sweet position. Only one thing which I would like to give a caution to all your listeners, your viewers, is that in last 45 days in particularly, we have seen everything is basically, it's like a momentum market. 10 रुपया 20 रुपया वाला stock था, वो 50 रुपया हो रहा है, 80 रुपया हो रहा है. I don't know why, because maybe there is an investor who is thinking that 10 रुपया वाला 50 रुपया जल्दी हो जाएगा. So that's the kind of a caution I would just like to play, that don't go overboard, don't do any excessive speculation, don't do any excessive trading, because a company without much fundamental definitely will come back. The stock price will come back to where it was. So just remember that thing. Don't go in overboard into anything, Remain disciplined investor. The time has come, and I think you are going to see wonderful opportunity. Many companies, on an average, we meet one company a day, Gaurav. And I can tell you there are many companies who are saying that we are at the cusp of we are at the inflection point of the next growth cycle.
Thanks, Rajesh. I will start off the next question with you. So before we really try to talk more long term, I'll just stick to 2023 for this one more question. So next year, when you look ahead, what are you looking at? Are you looking at a more broad-based rally, or you're seeing a more selective rally focused on just a few sectors, or just just a few narrow stocks? So how are you really looking at it sitting here at the end of 2020?
Very good question, Gaurav. Let me be very frank with you. To be very frank, internally, we do not focus too much on will it be a broad rally or will it be a narrow rally. Who knows? Nobody knows the future. I wish any fund manager would have answered to this question. What we do is that try to identify opportunities where we think we can make money. Whether 500 stock upar jayega ya 5 stock upar jayega, beyond a point, I don't care. What is important for me and for my investor is that how can I make wealth for my investors? And if I can identify those opportunities, those 20, 30, 40, 50, 60, 70 stocks out of 500 kind of a companies which we track, and if these companies deliver double earnings over next 3-4 years, which we always normally target, our job is done. Because that means 18-20% CAGR compounding returns over next 3, 4, 5, 7 years. That's what we target internally, right? So what I'm trying to say is that there are n number of opportunities across sectors. Banking, I think there is a huge opportunity. Credit cycle is just beginning of the credit cycle. For the first time, Gaurav, the non-food credit growth has been double digit after 13 years. I'm telling you, after 13 years, we have seen the double digit non-food credit growth. The asset quality issues are behind us. Borrower has deleveraged. The lender is willing to lend. We have never seen such kind of a great combination in last 10 years. So banking is going to do well. The capex cycle is just the beginning because the government, a lot of efforts on PLI and many more such initiatives. I'm sure everybody knows about it. The capex is at the inflection point. China plus one, it means good thing for specialty chemical. Europe plus one is a good thing for auto ancillary and capital goods. And of course, the rural India, which has been impacted in last 6 months, they will now revive because of the better Rabi crop. I think rural economy will also come back and will start contributing to the consumption side of story, which has been a little bit impacted, I would say, in last 5 to 6 months. So these are the various sectors in which we see opportunities. Organized sector in particular is going to do extremely well. They will win market share. They will keep delivering, what I would say, because of the lot of consolidation in every sector. And that's how to basically make money for investors. Do not focus too much on macro or narrow or 5 stocks or 30 stocks. I don't care. I need to identify companies, and there are enough opportunities where we can make significant wealth creation for the investors.
Thanks, Rajesh. Pankaj, passing over the same question to you. 2023, is it looking at a broad-based rally, or full of broad-based opportunities, as Rajesh said, or you are expecting a far narrower market with only select sectors really moving?
Our sense is that, 2023 is going to be, we are going to see a more of a broad-based rally across various spectrum of markets. But having said that, not that every segment, every stock is going to perform, I think, which is where probably some selection bias is required. Because to highlight, say, for example, auto as a sector is looking very good for next 2-year perspective. From the overall growth is expected to be in double digits for both, say, CV plus four-wheelers. But something similar cannot be said for, say, two-wheeler as a category, which has been sort of struggling. And this is one category which is also more prone to disruption from the electric two-wheeler. So from that perspective, not all segments would look or can be looked at from a uniform perspective. Having said that, I'll come to the broader question. So our perspective is that if the domestic economy is sort of shaping up well, I think government is making all the right kind of noises and policies for each and every sector, then our sense is that you are going to see a much more broad-based rally, which can pan out for the next 4-5 years, if not longer. And within that, yes, you will see participation across sectors, largely, typically in a situation like this, when domestic economy does well, our sense is that the mid caps and small caps do a lot more better. But within sectors, if I sort of to highlight, like I said, not everything is going to participate with the same intensity. Say even say within banking. Now, if you look at say PSU Bank as an index is up about 70%, and Nifty is up only 5%. Whether all the PSU banks can sort of keep delivering that kind of growth even next year, or will sort of outperform private sector banks, probably unlikely, because somewhere down the line, when whatever re-rating has to happen because of valuation happens, then I think market is going to focus more on growth. Which bank can deliver more sustained growth with lesser accidents or lesser credit costs, I think will find favor. So, which is where I think this selection would be required, or where I think you need judgment or an expert advice to sort of come in. Otherwise, in general, markets are looking good to us, but I can talk about across sectors. You'll have within every sector some pockets structurally looking to do a lot more better. Some may not sort of do that kind of well. So it's a broad-based rally, but within that again, one needs like Rajesh also highlighted. One should not be really down trading in terms of quality. So I think that is what one needs to sort of keep in perspective.
Thanks, Pankaj. So next question, I'll start with you. And, instead of just focusing on 2023, maybe if we take a 5-year horizon, which sector or which pockets of opportunity do you really think will work over the next 5 years? Which are the clear trends that are emerging?
So I think if I have to sort of look at for next, say 4-5 years, I think one is, India is a consumption-driven economy, and I think consumption, especially discretionary consumption, is looking particularly strong to us. I think what we have seen in the last 3-4 years is that overall the salary hikes have been pretty decent. So affordability has gone up, whether it is for real estate, whether it is for autos, or a lot of other consumer discretionary products. And our sense is that when you sort of look at even a sector like real estate, I think last 8 to 10 years, this sector hasn't done well. But now when you see inventory is at lifetime lows of say around 21 months, and we have seen all your organized developers, now they contribute or they have a market share of 25%. Mind you, this was single digit. And thanks to RERA, we are not seeing that kind of accident what probably China is experiencing in terms of buyers ending up paying the entire value for a property and eventually not even getting delivery of it. I think we have already gone through that share of pains. Similarly, when you sort of look at autos for a meaningful period, we haven't seen much of a sales growth in autos. I think this is 1 year we are seeing that kind of a number. And our sense is even the auto structurally look good according to us. So discretionary auto plus real estate, and along with that, we would want to believe that the entire ancillary lot. So, for example, when the real estate does well, obviously after a certain period of time, you see demand for paints, you see demand for switches. A whole lot of things, be it tiles, be it a number of other household products. I think that sort of demand goes up. So which is why consumption is something which is looking structurally positive according to us. The other thing is when you sort of look at manufacturing. Now, manufacturing has been an area where we have been sort of lagging for quite some period of time. And I think thanks to government, the government has come up with PLI schemes and with an outlay of near closer to 2 lakh crores. And our sense is that it's a sort of a structural in nature. Two case in highlight is that, so for example, when you look at even textiles, so while a lot of companies have been exporting to US market, but when you're sort of looking at going forward, our sense is that when a lot of these FTAs get signed up, you'll see a lot more opportunity opening up in a sector like textile, which has been one sector which hasn't really sort of grown from an export perspective. And similarly, I think when you look for all the other components, so for a number of sectors, the government has come up with a PLI. So with an eventual aim that the overall contribution of manufacturing to GDP, overall GDP will go up. So I think overall manufacturing or as a segment is also sort of looking good according to us. And to support that manufacturing, obviously capex or capital goods is a sector which is looking structurally very positive to us. I think after a long period of time, we are seeing a government clearly focusing on capex. Last 3 years or last 5 years, the government capex has grown at a CAGR of about 23%. We have never seen that kind of a capex intensity by the government. And our sense is that this tempo is going to be maintained for next 4-5 years. So I think it is a matter of time. We have not only the PSU capex but also the private sector capex doing well. So the entire again capital goods as a sector also sort of looks structurally positive to us. And when I I'll come back to on the consumption side. So in consumption, it's also about, say, for example, a sector like hospitality. I mean, when you sort of look at the hotels across, the room rates are sort of quite good. The occupancies, we have never seen in a dull season, occupancies of that kind. Similarly, when you look at hospitals, I think our sense is that this is also a sort of a necessary consumption, which can sort of keep doing very well. So in fact, I find hospital probably slightly better than FMCG in terms of a growth plus risk reward perspective. So I think you get a lot of consumption related categories which are expected to sort of do very well going forward.
Thanks, Pankaj. Rajesh, while I know that you are a very, very bottom-up stock perspective, and you've already talked about some sectors that you like, but still, if I have to look at from a next 5-year perspective, what are the key winners that really come across from your point of view?
Well, I think, Gaurav, what happens is that, I think Pankaj has covered probably almost all sectors. So I will not again repeat what Pankaj has already conveyed and I also discussed probably. So what I would put it in, think differently. In India, there are 5,000 listed companies. And out of 5,000 listed companies, there are only 500 companies which makes profit in excess of 100 crores. That's it. Only 500 companies makes profit of 100 crores plus. Out of that 500 companies which makes profit of 100 crores and above, maybe there are only maybe 350 companies or so where the discipline of capital allocation is very strong. Prudent capital allocation, basically return on capital employed, correct? And out of that 300 companies, if you remove the commodities, the list further reduces to 200 companies. What is our job? Our job as an active fund manager is to make sure that we identify the right opportunities. That's what we do. In these 200 companies, we try to identify opportunities. And for example, in one of our portfolio, which is there on Master of Trade, Triple Emerging Business Opportunities, we identified many companies which are very, very niche business segment, extremely niche business segment. Probably there is only 1 or 2 players in that entire industry. Think of it. I'm talking about only 1 player in the entire industry. Now, irrespective of what happens to interest rate and what happens to macro and, capex, government spending, not spending, beyond a point, what matters is right to win. Whether my company has a right to win, irrespective whether US becomes 1% GDP growth or 0% GDP growth. Because nobody knows the answer. Will US grow at 2 or 1? It's all a matter of judgment. But when I'm buying the companies for my investor, I need to make sure I don't lose capital and I make money irrespective of interest rate little bit going up or down. Correct? And that's precisely what we need to focus on. Right management, right governance, right financials, making sure that the companies have the great capital discipline. And of course, without growth, there is nothing. Companies must have the right to win, to capitalize on this fantastic opportunity of growth. And that's what we keep across the sectors. If you look at my portfolio, we would have, probably 7 to 8 sectors across these sectors, we basically select the companies and we buy into the portfolios. And these companies, many of these companies, they are basically incubating companies within it to become a multi-bagger. People ask us that, like you asked that, what do you think will move up? And therefore, what we do is that we identify the traits of a success. What makes success to the company? What makes stock ultimately to deliver the returns? And that trait is making sure that every company has a number of growth engines which are firing in the different environment of world markets. So for example, my chemical companies, they are doing extremely well. One of my company has a 65% market share in the world market. Irrespective of whether India grows 6 or 7, it doesn't going to make any difference to this company. Correct? Many of my companies in CapEx, they are not bothered about whether government or state government or CapEx will double or not, because they are focused on automation. They are focused on robotics. They are focused on process engineering. And if robotics and automation is going to work, then irrespective whether government spend 10% extra or government spend 20% extra, of course they need to spend, no doubt about it. Incrementally, it will not make much difference. That's the moat I'm talking about. Money is to be made from the moats of the company. And that's basically our strategy to keep identifying such opportunities.
Thanks, Rajesh. So, Pankaj, I'll come back to you. After a long time, banking sector seems to have regained its outperformance, but this time as you also mentioned, the winners of this rally are different from the last winners of the banking rally. So do you think this is the start of a secular rally within the banking sector? And how do you think the entire rally will play out? Will we have a different set of winners this time compared to the focused retail centric banks that really did extremely well over the last week?
So Gaurav, very good question and a bit complex one to sort of answer also. But when we sort of look at overall banking and as an index, our sense is that BFSI overall contributes nearly 1/3 of Nifty. And so from that perspective, if BFSI does well, obviously it is good for the market. Structurally, we don't see this weightage meaningfully sort of going up from current levels. Now, when you come to the individual components, you have components like, say, NBFC, you have components like private sector banks, you have PSU banks. Now, within that, private sector banks, our sense is that are sort of very well priced. We don't really see a meaningful scope for re-rating of private sector banks. Now, it is possible that the private sector banks can deliver higher sustained growth compared to PSU counterparts and without obviously having lesser credit sort of excellence. So obviously private sector banks can sort of relatively outperform. But I think one needs to be very selective in PSU banks, because now in PSU banks, what we are seeing is obviously there has been a history of underperformance. We have seen in the down cycle, most of your PSU banks get impacted substantially by asset quality. But I think a lot of structural changes are also sort of taking place. So for example, if government appoints a top management who stays for a period of 10 years, I think they can implement and strategize a lot more and can be accountable for those strategies as well. So I think we need to see some benefits of that sort of playing out. But till that time, our sense is that overall private sector bank
Pankaj, I think you're on mute.
Yes, sorry for the, I think, for the technology issue what I had. Now, what I was saying was that when you sort of look at PSU banks, yes, there are some structural positives which the government is working out, and that can sort of propel a bit of a more re-rating. Because when you look at from a valuation perspective, except for SBI, most of your PSU banks trade below book values. However, it is still unlikely that these can trade that above book values, because when you look at last 8 to 10 years, the kind of money government has put in, so that has sort of bloated their net worth. On that, if they have to make double-digit ROEs, I think it is going to take a lot more time. So banks plus NBFCs, again, we have been positive more on, or structurally we have seen that B2C NBFCs are a lot more better compared to wholesale funded, because NBFCs take a lot more higher risk to deliver that kind of a profitable growth. So private sector banks plus B2C NBFCs I think, are a better combination. But PSUs can be an interesting bet, again, subject to, I think we need to see some fruits of the government policy sort of bearing out. So if that happens, possibly PSU banks can do better. But I think it's still difficult to say or comment at this point in time.
Thanks, Pankaj, for such a detailed explanation. Rajesh, flipping this question over to you. Do you think the secular rally in the banking sector has just started? And what is the flavor of the rally going ahead, given its constituents? As I highlighted that maybe in the last decade, it was just the 2-3 banks which had really worked. Do you think this is going to be a far more broad-based rally in the banking and financial services this time?
Well, banking is a very, very interesting sector. It's the easiest business in the world is to lend. And the most difficult business in the world is to get it collected. What happens in the first phase of credit boom? Whichever company reports higher loan book growth and higher net interest income growth, everybody, stock price may go up. But only after 3 years, when the payment is due from the borrower, you come to know the credit discipline of the lender. We really need to be very, very prudent in making sure that we don't get carried away by just looking at that, credit growth is going to go up and therefore everything will go up. Yes, everything will go up. But then everything may not sustain the stock price which went up. That's what I was telling in the beginning. In last 7 days in particular, I have seen many stocks, particularly within even banking and finance, where despite no fundamental strong backing, without much strong credit asset quality, there are many stocks which have run up. Few stocks have run up by 50%, few stocks have run up by 75%. You need to be careful. You need to be very, very prudent in selecting the right bank, whether it is PSU or whether it is a private. It is not only a fundamental right of private sector bank to deliver the ROA and ROE, even public sector bank can deliver. So we need to keep open mind. I'm open for both PSU banks and private sector bank. We already have exposure to State Bank of India, Bank of Baroda and Canara Bank. Please put a disclaimer in case if I'm talking about it. These are the 3 banks what we have selected in our public sector banks basket. In private sector, of course, we own most of the top 5 banks of the country, including ICICI banks of the world. And that is our position from quite some time. And the PSU banking, we added probably SBI was always there, and we added a few more weightage in the last 3 months or so. But beyond that, I will be very selective in buying any bank, whether it is public or private. You need to be really very, very careful. Few important things which you need to monitor is, one, what has been the conservatism policy of the institute? Very important. Just don't go by reported number. What is the previous past history in terms of how much bank is willing to provide, how much bank is willing to be conservative? Very important. Second, very important is that what is happening to the loan book mix. And last, third, but most important, about the liability side of the lending institute. Because for bank, the liability deposit is nothing but the raw material. Without raw material, you can't do anything. Am I right? And not every bank is very strong when it comes to the liability management. So these are the three important points, of course, apart from management and so on and so forth. So we are very bullish on the overall credit cycle. We believe India has just entered a next, probably beginning of the next bull of credit cycle, just like what we have seen between 2003 and 2008. So we are really very bullish on entire banking and finance space. But within banking and finance, what I'm trying to say is that be very, very selective approach. Because please remember that, after 3 years and after 4 years and after 5 years, when the credit cycle gets plateau and then again when the slowdown starts, it should not happen that you are left with the companies where stock price goes down 90%. And it has happened in past, globally, it has happened in last 60 years. There are many instances that many of the global lending institute stock prices came down by 90%. I repeat, 90%, and that's true globally. And I'm talking about the top 5 world institutions in the world, not only in India. And India is also experienced, and I'm sure everybody knows here. So be very, very prudent. Don't get carried away. Don't play speculation. Don't play trading game. It can be dangerous. Keep a long-term focus. Very, very important, particularly in this side of the sector.
Thanks, Rajesh. So, we will now focus on really the specific portfolios that you manage. So you are advising 2 portfolios, the AAA Emerging Business Opportunities and AAA Digital India on ICICI Securities Masters of the Street platform, which have given 16% and 18% per annum returns since inception last year. So in light of, all our discussions, maybe if you can really focus on how you're managing those strategies, and for an investor who's willing to hold on to 5 to 10 years, what is the kind of return expectation that he should have? And maybe if you can highlight what are the risks that are involved in your style of investing.
Okay. The first most important thing, irrespective of which basket we talk about, we have 2 products, as you rightly said, and what I'm saying now is true for both the products. Our entire investment philosophy is how can we protect capital and create wealth? So risk management is very, very important. I'm sure throughout the conclave, not only last 2 days, but periodically ICICI Security does many such events for the investors. And I'm sure many participants, guest speakers would have talked about how good we are in selecting the stocks, identifying the themes, and many more such things. But probably less is spoken about how we manage the risk. And that's very important. And one ingredient of the risk management is a disciplined exit strategy. What to buy, everybody knows. When to sell, that's where the fund management experience, the art and science of fund management comes into play. So what we do internally is that we keep checking that where are we going wrong? Very important. Wherever we believe that our assumptions probably may not come true, get out of it. Very important. So I'm starting with the reverse order. Instead of telling you that how we buy and what we do, I'm starting with the reverse order. Once we bought, because we have enough experience, so with a fund management experience of 27 years personally and 82 years at the combined team, we know how to buy and all that stuff. But where we still improve, where there is a huge scope of improvement, even for us, despite 28 years into the market, is how can we become better and better and better in getting out at the right time. Because 75% of Sensex has changed in last 16 years. Yesterday's blue chips are today's red chips. And there is no guarantee that today's blue chip will remain blue. It may turn even red chip 10 years down the line. MTNL, DLF, Jaiprakash, Glaxo, Century Textile, all they were blue chip companies in 10 years back. But today nobody talks about it. So very important part of our strategy is when to exit. That's one important part. And second important part when you talk about the portfolio is that we make sure that we not only buy the right companies with the right ingredient of growth, but we also make sure that there is 0 debt on the balance sheet. Now that's a really super combination. One side you have a growth to create the wealth, and second side you have a debt-free balance sheet to bring the resilience to the portfolio. And when you combine this growth with the zero debt balance sheet and high ROE and high ROCE, by default, you get the better outcome. And that's why we have delivered not only on Master of Street, but even for our PMS, we delivered 19% compounded now for 13 years. So 1 crore roughly became like 9 crores or so. And that's the mantra what we follow on everyday basis. And even in these two portfolios, if you closely monitor our portfolio, wherever change was required, we are very active. We sold, for example, IT stocks before software meltdown started. In our AAA Digital India portfolio, we made sure that we don't buy any company which were on the platform side at an extreme high valuation. We avoided that entire, what I would say, damage. Despite the companies were falling into our universe because they were really, truly digital, in Digital India portfolio, for example, we played the capex story by not investing into the construction company, but by investing into the company where there is a robotics as a mode, technology as a mode, research and development as a mode, a parent company's availability of the patent is a mode. So, for example, we have a ABB in our Digital India portfolio. In our emerging business opportunities, same story we played through Siemens. Again, the best of the company, zero debt balance sheet. And right now, of course, they are the biggest beneficiary of the railway capex on the India side. When it comes to the AAA emerging business opportunity, we played China Plus One through our specialty chemical approach. Right now, from last 6 months or so, we sense that Europe Plus One is going to be the next biggest theme. And capital goods companies and auto ancillary companies are going to be the biggest beneficiary of Europe Plus One trend. We have a Craftsman Auto in our emerging business opportunities. Banking and finance, of course, as I said, we have been very bullish on this name. And in both the portfolios, we have the combination of best of the public sector banks and best of the private sector banks as a combination to play the banking and finance as a theme. And very importantly, in the entire portfolio, we kept asking, what is the digital resilience of every company? Because world is changing fast. The disruption is happening at an unprecedented speed. And therefore, it is very, very important that the company remains relevant even for tomorrow. Because if they don't remain relevant through digital resilience, then somebody else will probably become number one instead of our existing company becoming number one. And that's very important for our entire portfolio across our universe. That how are they positioned to capitalize on the growth? And how are they positioned to make sure that they don't get disturbed by disruption by the competitors? Very, very critical factor for us. So both this portfolio, just to conclude, when you actually plot the portfolio characteristics, all are market leaders, very, very important. They keep gaining the market share. They all are market leaders. They are the best of the management. They have a zero debt balance sheet. They have a high return on net worth and high return on capital employed. They have 18 to 20 to 25 to 30 to 40% earnings growth, sustainable earnings over the next 2, 3, 4 years. And therefore, we believe that both the portfolios are rightly positioned to capitalize on the growth opportunity and also to make sure that they don't draw down, they don't lose capital, they don't participate equally when the market downturn comes. Very important, the risk management part of it. So that's basically the characteristics of both the portfolios, and we believe that they are rightly positioned for the really good long-term superior returns. Probably significantly better than the benchmark returns over the next 4 to 5 years.
Thanks, Rajesh, for such a detailed explanation. Pankaj, over to you. You also offer a lot of research curated baskets to our clients, from diversified portfolios like all other multi-cap, leaders of tomorrow, capital compounders, and also, thematic strategies like rising capex and unorganized to organized that you have offered. So again, if you can give us a flavor in terms of how do you really manage these strategies and how do you manage, risk, or what is the key risk in some of these strategies that will really help all of our viewers?
Sure. So I'll sort of adopt a slightly sort of easy approach. So for example, when we sort of look at a company, this is standard practice across all sectors and for all portfolios. So for example, when we look at a particular company, we look at how capital efficient this company is. And say, for example, if a company is making a ROAS of say 10, 11% And if there is a down cycle, if that ROAS sort of or margins come down and ROAS eventually sort of falls to say single digit, then I think it is very likely that the company will struggle to sort of survive. So we will never ever touch companies which are boundary line cases. Because what happens that if you are picking up a good ROAS company or capital efficient company, and even if they venture into some new business and that business does not click, at least if your ROAS is or you are capital efficient, it allows you to make that mistake. Otherwise, we would not really sort of chase. So I think capital efficient business is definitely what we sort of look at. Similarly, I think the other perspective, what we are very clear is that we would want, typically India is like for growth. India, when you sort of look at companies across sectors, I think, so our sense is that growth has to be there. And preferably the path to growth also needs to be with secular nature. We don't like, typically even also investors don't like which have a volatile history of growth. And I think besides that, I think some of the simple things, for example, if your balance sheet is, if you look at some of the balance sheet items are growing faster than your P&L items, then I think those are the set of companies which we sort of really do not chase. And mind you, we are not fixated by the fact that we aim to buy the cheapest stock and sell expensive stock. So wherever we find this combination of growth and capital efficiency working together, we look at stocks, and that has been our approach in Leaders for Tomorrow. In Leaders for Tomorrow, it's a small cap portfolio. Typically, beside this, what we also look at is that we look at multi-bagger approach. So if you are sort of mentally sorted that a company can become a multi-bagger, say in the next 3 to 4 years, we would look for those companies as part of that. And when you sort of look at, say, all weather is again a multi-cap kind of a approach, again with a similar sort of a mindset. And when we sort of look at capital compounders, then our sense is that, see, these are well-established business models where the growth rate is good, the capital efficiency is good. There are no major surprises in terms of overall growth as a setup. So someone who's not really looking at volatility in their portfolios, I think that so that is where or those that particular portfolio is largely apt for them. So I think when we sort of look at portfolios, what I mentioned in terms of capital efficiency growth, I think that's a standard format across all the portfolios. And then obviously you have various themes which we work on. So for example, unorganized to organized is one theme which you feel will keep sort of panning out. I mean, take the classic example of, say, jewelry as an industry. While overall, this 3 lakh crore market has largely remained stagnant. But when you look at tier 1 companies like, say, Titan sort of has grown at 25% CAGR in the last few years. They're expected to grow at 20% CAGR over the next few years. So that way, obviously, it means that there is a shift happening from organized to organized. And look at the entire apparel as a segment. Now, this is one segment where the overall recovery from pre-COVID levels have been pretty good. Something like Trend has, the sales have now doubled from pre-COVID levels. So apparel is another category where we feel that overall the shift is happening from unorganized to organized. I mean, even in a category like paint, you still have about 20-25% kind of a market, which is sort of unorganized. So we are looking at themes where shift is happening from unorganized to organized, and it sort of not only helps the company sort of deliver better, even if there is a sector growth which is not panning out. I already highlighted the example of jewelry as a segment. I think something similar is happening in a number of segments, and I think it's very good for the economy also because stock market typically is more focused towards the organized part of the market, and if that market grows better than the overall sector growth, I think it's good for the investors and good for the entire ecosystem as well.
Thanks, Pankaj. So, we have a few questions that have come from the audience. So, let's just pick up some questions which have maybe not been covered earlier. So the one question that we have is IPOs have generally been considered to be alpha generators. Many IPOs in the past have become multi-baggers. However, the same has not been true over the last year. What are your expectations going forward? So maybe any of you can pick it up. Rajesh, if you want to pick it up.
Yeah, I think, for us, every company, whether it is a coming out with an IPO, whether it is a listed company, our framework remains the same. In IPO, what happens, there is a lot of, what I would say, noise factor, a lot of momentum factor. And that's where you actually need to be very, very prudent. In fact, if you look at, there is a IPO index, I think BSE IPO index, it gives the track record of the companies which have launched IPOs, am I right? And if you look at their performance, probably 70 to 80 to 90% of the IPO companies fail to deliver long-term returns. That doesn't mean that you should avoid IPOs. What it means that you need to be very, very selective. Of course, that 1%, 2%, 3%, 5% of their IPO companies, they make disproportionate money, undoubtedly. But that's where the selection comes very, very important. Because वो मोमेंटम में क्या होता है ना, बहुत टाइम चला जाता है, बहुत लोगों को बैंडविड्थ बहुत चला जाता है, एंड फाइनली it is not worth the time because IPO companies always look at the premium valuation compared to even the listed companies. In fact, if you look at the company what is looking for the valuation, with the better company already listed with the 3x size in revenue terms and 3x size in profit terms, and with better ROC and better capital discipline, generally speaking, in a listed space, you get that company at significantly discount compared to the new company which is coming out as an IPO. And you are taking so many risks when you buy an IPO company because the management doesn't have history of how to handle the minority shareholders. And we have seen, particularly in last 12, 18 months, how the hype of IPO, how people get carried away. And that's where the blunder happens. That's where the mistake happens. And many of those stocks are down 20, 30, 70, 80%, very bad. Very sad to know that, correct? So we have been very, very extremely selective, to be very frank. We generally don't chase IPOs, to be very frank. We believe there are enough opportunities in the listed space. Be very selective is my one-line answer to all the viewers. Please be extremely selective. Don't get carried away. 90% of the investor, they look at the, some newspaper, what is the off-market premium or something like that. And then you decide to invest. Most of the time you invest because your neighbor is investing, and definitely that's not the right way of investment just because your neighbor is investing. So be very, very prudent, be very, very selective.
Thanks. So another question that we have is how would pharma, IT, and the export-oriented companies expected to perform over the next couple of years? Pankaj, if you want to really take it.
Yeah. So on the pharma side, if you look at now, we all know that pharma is sort of struggling, especially in the export market. So all export-oriented pharma companies have really not done well. There's a lot of price competition here. And our sense is that one needs to be very selective in a market where you are seeing too much of a price competition. In fact, any sector, if there is too much of a price competition, it's not very healthy for the industry because it constantly puts pressure on the margins and it does not really help the industry much. I think airline is also a classic example. So something similar is sort of panning out in the exporters as well. But yes, there are some selective players, say for example, Sun Pharma, which is sort of doing well because now they are saying that largely, or the expectation is that the share of specialty products will improve from, let's say, 15% of their overall top line to 30%. And by the way, US contributes around 30% of their top line. So that will lead to better margins. But like I said, it's a very tough market to sort of crack in, quite price sensitive. So when you sort of look at, I think the domestic market or the domestic oriented companies are looking a lot more better. At least we see a secular growth of 12 to 13%. And I think that is an interesting space to be into. And our sense is that probably this is one space which is sort of ignored by the market, which can sort of come into limelight. Now, some of the other export-oriented sectors, say for example, textile is also sort of looking attractive to us. I think last few months, if you sort of look at, there's been too much volatility in the cotton prices, and that has sort of impacted companies' utilization. Whoever is on the wrong side of the inventory, there has been inventory losses, and all kinds of things. But our sense is that now things will move a lot more structurally here, because our sense is that India is already one of the few countries where cotton is sort of grown in quite decent quantity. Then I think we have now labor is not a big issue. So our labor cost is very competitive, quite lower than a lot of competing peers like say China. And then I think on the spinning side, also we are sort of looking to sort of add, and mind you, this is one sector which is sort of labor intensive as well. So our sense is that the government focus is going to be there. And then, mind you, we are looking to sign a lot of FTAs, which our sense is that could be beneficial for the entire ecosystem. So, yes, there are some pockets which are sort of looking good. Some are sort of impacted. Similarly, I think IT, when you sort of look at, our sense is that while, yes, we have seen a decent amount of price decline, but overall, whatever IT spend you see is our sense is that it is not it's not that discretionary. In fact, a lot of IT spend is for cost saving and other purposes also. And with US witnessing such a high labor inflation, or the wages are quite high, our sense is that we might see a bit of a slowdown there, but overall IT as a spend is going to sort of continue. I think when you sort of look at new apps, a lot of AI or a lot of data analytics sort of goes into, I mean, you can experience, a lot of you would have experienced yourself. So IT as a overall spend is going to sort of increase. I mean, look at autos, you have ADAS as a standard feature, which is now sort of looking to sort of come into play in the next few years. So that is one level below autonomous driving. So that requires good amount of technology. So technology is something which is going to get far more ingrained in lots of products, and which is where I think the Indian IT will continue to have a lot more role to play. So pharma selective, I think textile looks good. And I think when you sort of look at IT, IT looks good according to us from all the structural perspective. There could be a period of ups and downs, but our sense is that these pockets are looking good. So I think that is what I would have to share on the exporter side.
Thanks, Pankaj. So maybe I'll just take one last question for the session, and before we close it. So I think, Rajesh, this question is directly towards you. You have been so bullish about the Indian companies and stocks. So I think the question is that are we really factoring in the threat of global recession in US, Europe, while we are talking about the themes in India, all the underlying construct?
Very good question. I was waiting for this question. Last 60 years, if you look at last 60 years, I repeat, the US economy and the US Dow Jones Index, whenever the US recession, that is a GDP, recession means GDP negative growth. For the viewers, to make it very simple, recession means minus sign on GDP. Whenever it has happened in US, in that year, the Dow Jones was up 19%. It has happened 3 times since 1950 to 2022. And each of that 3 years, Dow Jones was up 20%. Why? Markets are always ahead of time. Please remember, when you, the investor, and the Ola taxi driver talks about the slowdown and recession, markets have already factored into it. That's the reason why the global markets were down in the month of March, in month of April, in month of May. That's why the Nifty was available at 15,500 levels in month of June. Correct? So recession, will it come in US market? 99.9999%. Yes, there will be recession in US market the next year. How much it is already priced in? Bulk of it is already priced in. Can market go down another 10% from here? Always, equity markets are always, volatility is always part of equity market. But let's talk about equity market in India. Forget, now we are already talking about world enough. We are going to invest in India, am I right? In India, the question market, 6% growth होएगा कि 7% growth होएगा? Am I right or not? Question is not 0 versus 6. वो US का प्रॉब्लम है, उनको झेलने दो. हमारा क्या है? 6% growth या 7% growth. In both the scenarios, our corporate India will deliver either 12% earnings growth or 15 to 17 to 18% earnings growth. And therefore, in both the cases, we will make money. The Indian investors with a little bit long-term patience, by long-term, I'm not talking about 30 years, I'm not talking about 20 years, I'm talking about 3 to 4 to 5 years. इतना टाइम तो देना पड़ेगा इक्विटी मार्केट में इन्वेस्टमेंट करने के लिए. Then you will make enough money. Believe me, so much people are just worried. You know, yesterday I was telling to my investors, Gaurav, that these are time to get disconnected. You know, we get so much overburdened by so much information. WhatsApp, Times, you know, CNBC, this, that, recession, deflation, inflation, debates, discussion. तो क्या होता है एक्चुअली अपना जो मेन ऑब्जेक्टिव है, तो मेन गोल क्या है? मेन गोल है टू मेक मनी इन द लॉन्ग टर्म. Correct or not? But because of so much of the information, investor get confused. And वो बोलेगा मैं 10% नीचे जाएगा ना, फिर हम लेंगे. फिर 10% नीचे भी आता है, फिर वो सोचता है और 20% नीचे जाएगा ना, then we will buy. And in that entire journey, he misses the bus. Guys, I can tell you only one thing. Please don't miss the bus. There will be obstacles. Signal आएगा, red signal will come, but that doesn't mean that you get out from your car and start walking from Bombay to Pune by walk. This is not going to serve the purpose. Am I right? Stay invested, and very important, stay calm. Volatility would be there. Embrace the volatility. Take advantage of the volatility. Don't worry about the volatility. We have done enough reforms, and all the hard work of the government of last 5 years already reflecting in your GST collection. There is no country in the world where we have seen 15% GST compounded growth for 3 years. We have not seen it. कैपेक्स साइकिल का तो अभी बिगिनिंग चालू हुआ है, क्रेडिट साइकिल का तो बिगिनिंग अभी चालू हुआ है. सो देयर आर इनफ मैक्रो फैक्टर्स व्हिच आर वर्किंग इन आवर फेवर. Organized sector is going to do better than unorganized sector. I don't think that requires any, it's not a rocket science, bound to do better. And within that, good fund managers, good advisors, they will select the right companies, position for the right growth, be disciplined. Don't get speculative mode. Don't get excessively into, you know, day in, day out kind of a game. That is not going to be rewarding. Markets are going to be volatile. Be very, very selective. Don't buy any dumb stocks because then you will lose your capital. Be very, very selective. Prudent wisely. Create wealth and enjoy the wealth.
Thank you so much, Rajesh, again for that entire positive spin on things. And thank you so much again, both Pankaj and Rajesh, and thank you all of our viewers for watching this Masters of the Street Conclave 2022. I hope you really enjoyed it and enjoyed the insightful discussions that we've had today. Thank you so much.
Thank you, Gaurav. It was a great
pleasure is all mine. Yeah, thanks, Gaurav.
You know, really great opportunity to interact with investors on this weekend, and enjoy the weekend, guys, and enjoy the wealth. Thank you.
Thank you.